Hello guys, this is my trading journal for Friday the 26th of February. The market volatility that started earlier in the week continues into Friday, and both the equities and rates markets saw an uptick in volatility. At the close today, the Dow was down 470 points, or down 1.5%. The S&P 500 was also down half a percentage point, and the Nasdaq was up half a percentage point, having been down significantly more than the other two indices yesterday and the day before. And you can see from the heat map, it is largely red, with Amazon, Facebook, Google, Microsoft being the outliers. They were red yesterday, and today they're making up a bit of ground. The sell-off started off as a rotation from growth into value, and then it turned into a broad-based sell-off. And the sell-off has been largely due to a rise in the 10-year Treasury interest rates. The 10-year Treasury was down about 104 basis points today to close at a yield of 1.407. That is lower than where we closed yesterday when it was above 1.5, but the volatility, the rise in the yield unleashed when the rate broke above 1.6, it still permeates the market. Let me show you a chart of the 10-year US Treasury, the rates on the US Treasury. So this is a chart of the 10-year US Treasury going back to 2011. And you can see that by historical standards, the rates are not particularly currently high at 1.407, which is where we closed. If you look around here, this is around so this is 1.5, and you can see it was the low in 2016-2017, the low in 2012-2013, and it's been the highest level since last year, I guess. Yeah, it's the pace that spooks the market. It just shot up above 1.5. Let me see if I can get a 5-day chart to emphasize this area here where it shot up. So this is a 5-day chart of the 10-year US Treasuries, and you can see the rapid move upwards from, this is the 24th, this was, and it just shot up from here to a high of about 1.6, and although the rates have now come back down to around 1.47, the genie's out of the bottle in terms of rates breaking above 1.5. And there was a 7-year US Treasury auction yesterday, and that auction wasn't well subscribed. The Fed had to pay a higher rate to attract buyers, and the bond market appears to have pushed the Fed into a corner and calling the Fed's bluff. So rates either have to go higher, or the Fed has got to open up its balance sheet and throw more liquidity at the market to calm the nerves of the bond markets, or we might see rates going up further. And here is why the 1.5 level is so important, or why the market has so much significance at this 1.5 level. Rates at 1.5. It closed at 1.4. Let's call it 1.4 flat today, but yesterday it hit 1.6 and it closed above 1.5. With the 10-year US Treasury yielding 1.5%, that is the risk-free rate to earn 1.5% a year. So if you were to buy 10-year Treasury yielding 1.5%, you're taking no risk whatsoever. It's a risk-free rate. Theoretically, the US government is not going to default on its bonds, so that is the risk-free rate, and that's the benchmark for pricing risk across all asset classes. be it commodities, be it equities. That's the starting point. Now, the dividend yield on the S&P 500 is about 1.57. 1.57 is a yield on S&P 500, on the 500 stocks that make up the index collectively. When the 10-year Treasury was below 1%, it was easy to justify the valuations of equities. If the risk-free rate goes above 1.5 and continues to rise, then a lot of funds parked in equity and earning a dividend of 1.57 on risky assets no longer look a good proposition, given that they could earn 1.5 free of risk. And one of two things has to happen if that is the case going forward. Either the funds need to move into bonds to attract a higher yield, which means equity valuations needs to come down as money comes out of equity, or equity prices just need to come down to reflect the new reality that risky assets are yielding less than the risk-free rate. And there could be a mixture of both. And another thing with the growth companies, the tech companies, when they're borrowing money at below 1%, they can expand as much as they want. The moment they need to pay above 1.5, i.e. double the interest they're paying to borrow money, then that bites into their margins, and a lot of them are not making any profit anyway, a lot of the new tech companies that have high multiples. So the Fed, the market is basically backs the Fed into a corner. The Fed could step in and use its balance sheet to increase its asset purchasing program and pump some more liquidity into the markets, or the Fed could do nothing and see if the market is going to push the rates higher. Which of these is likely to happen? I wish I had the answer to that question, but it appears that the yield on bonds is on an upward move for now, until something stops it. I mean, it came down yesterday. Is this sustainable? I don't know. Some markets, fixed income people, fixed income traders were saying there were loads of stops at 1.5, and those stops pushed it back down. Is it going to be retested? And if it's retested, does it penetrate through and go all the way up? Nobody knows. But that is what the situation is, and that is what is spooking the equity markets. That's why the Nasdaq in particular has suffered more than the other major indices. The Nasdaq was up today, but that's because it was down 3% yesterday, down 2% the day before that. And I think it was down another 2 or 3% the day before that. And even though the Nasdaq was up today, for the week, I believe it's down greater than 5%. So how does this relate to my open positions, I hear you ask me? Well, all the sectors in the market have been marked down brutally this week, and I have got negative delta, so my positions suffer from a massive downward movement. So that's how it affects my open positions, my spreads. Am I very concerned about the current losses in my positions? Personally, I am not very concerned, and here is why. I play the long game, and I know that in the long term the odds are in my favor. I have made money yearly with this strategy, some years more than others. In other words, I have a reference point based on years of experience that gives me some comfort. Now, I do recognize that many members do not have that reference point. I recognize that there are some members in the forum who joined in January, and this March expiry positions are the first spread positions. There are members who joined in December last year who have not made enough profits to cushion any short-term losses. If I was in their shoes, if I was in that position, I would understandably be very concerned. And here's what I would say to you. Play the long game and do not let short-term setbacks impact your long-term outlook. I'm a half glass I'm a glass half full kind of guy, and I do not dwell on negatives too much. I have friends who always see the negative in everything. I have friends who could make $100,000 profits on a trade, and they would lament about the 35k they left on the table. So even though they just made 100k, instead of being happy or just moving on, being happy with the money they've made, they would lament and complain about the 35,000 that they missed out on because maybe they closed the trade too early or closed it too late. And then they would take that psychological baggage into the next trade and try to make the 35k they missed on the prior trade, as if the two trades are blood brothers or sisters, and that impacts their trading psychology. I try to wipe the slate clean after every trade and start afresh and remain positive and objective. And remaining objective and playing the long game has served me well over the years. And come every December, when I review my trades for the year, I have a smile on my face. So I know currently these positions are all showing negative P&L. We still have 21 days to go. We have 3 weeks to go. Anything can happen in a week, let alone 3 weeks. So I am not overly concerned, but I can understand anxieties from people who have only just started trading spreads or who haven't got house money to play with, if you like, because I believe I'm playing with house money at the moment, given my profits last year and the year before and the year before that. So I just thought to throw that out there. I know it doesn't erase the losses, but perhaps another perspective on how to look at it could make the loss make the negative P&L more acceptable. It's not a loss yet because the position hasn't closed out. Now moving on to the VIX. So the VIX was down today, and although the VIX was down about 3%, it is still much higher than where it was on Wednesday. Today the VIX closed at 27.95, but yesterday the VIX broke above 30. And the spike in the VIX is not surprising given all the volatility we have seen over the last week. Like I said earlier, there are now exactly 3 weeks or 21 days until the March contract expires. In terms of trade ideas, I had no new trade ideas today, and that takes me on to my open positions. The first one is in XL. XL sold the 17.5, 12.5 put spread. Let's see where it closed. So XL closed at $14.17, implied volatility 59. There is no way my 17.5 put is now deep in the money, and there is no way to sugarcoat the price action over the last few days in XL. It has been ugly. That said, there was some positive fundamental news about XL during the week, but the markets paid no attention to it, given the broad sell-off. It does, however, appear to have found some support around the 1331 level. So this is a 1-year chart of XL. Tuesday it did this, which was encouraging. The market came all the way down here and it pushed it up to close around here into the close. Tuesday was a doji non-event, open and close at the same point. Thursday wasn't good. The market opened here, they pushed it all the way down here. And Friday, this tiny candle here, really nothing much. So the price action is ugly, but it hasn't broken below this 1331 level. The sellers are not exactly slamming it down like they did on Monday. So this was Monday. You could see this was pure selling. Opened here, closed here, right at the low of the day. Come Tuesday, gapped down, Came down here, they bought it up a bit. Wednesday, not much. Thursday, not much. Friday, not much happening. So the sellers are not exactly slamming it down. They've pushed it down a lot. The question is, are buyers going to seize control and move it back up? The overall market is weighing on my open positions. Selling calls is off the table for now. There's another option offsetting my entire portfolio exposure. I'll cover that at the end. But for now, no action is required. I'm not going to sell calls in this. See if the buyers come in and try and fill this gap and move it up. But the sellers have clearly, from here, sellers had a lot of oomph. And then down here, the buyers are coming in and picking it up, but not much is going on here. Is it consolidating before moving up? And how long will that consolidation take? Will it take more than 3 weeks? Those are questions that need to be answered next week, and I need more data points to figure out what this thing is going to do. But for now, no action is required. In terms of my P&L, the P&L on this is currently negative $140 per contract. So this is XL, is showing negative 1120. I've got 8 contracts, and that works out negative $140 per contract. Moving on to the second position, which is in GNOG. On this one, I sold a 17.5, 12.5 put spread. Let's see where GNOG closed. So GNOG closed at 14.27, implied volatility 58.9. Again, my short 17 put is in the money, deep in the money. The price action over the last 2 days follows a similar pattern to XL. I'm not going to use ugly again. I use that for XL. The price action for GNOG was unattractive. Let me get the chart for GNOG. So the price action on Tuesday was kind of lovely. It came all the way, this green candle here, opened here, came all the way down here, and then the buyers managed to push it back above where it opened and closed around the top. That was beautiful. The follow through, even though it closed higher, the sellers seized control into the close. It opened here and then it closed around here. Thursday, the sellers came back and pushed it down, and Friday, a non-event. So the last 2 days, the price action has been inside this one candle. It's been an inside day, if you like. So this is Tuesday, and Thursday, Friday has been contained within it. What does that mean? Not much. Just struggling for control. The sellers had total control here. The buyers came in, and now again we need to get some more data points to find out who's going to seize control and move this thing higher. Have the sellers run out of steam, and can the buyers step in and turn it around? Next week we'll shed some more light on whether the buyers are ready to step in. But again, on this one, selling calls is off the table, and for now no action is required. Levels, I'm keeping an eye on for this one here. It closed above this level. Is that going to take it back up? Or are they going to push it down below here? And that takes me on to the last position, which is in MSTR. On this one, I sold the 820, 810 put spread. Let's see where MSTR closed. Actually, before I go to MSTR, the P&L on GNOG is negative 1124. I've got 8 contracts. That works out negative P&L of $140.50 per contract on GNOG. Now going on to MSTR. So MSTR closed at 750 and 14 cents. Implied volatility 89.3. The price action in MSTR has been encouraging. The buyers have been showing up and they have been trying to push it higher. This stock, MSTR, is strongly correlated to Bitcoin. It's got a positive correlation to Bitcoin, and Bitcoin has been moving all over the place this week. In terms of P&L on this one, my P&L is an MSTR minus 1,200, so negative 1,200. That works out about negative $150 per contract. Let me pull up the chart of MSTR. So this is the chart of MSTR. You can see Monday open here, went all the way up, and the sellers slammed it back down to close around the low of the day. Come Tuesday, the market gapped around here, and then came down here, and the sellers took control and pushed it all the way down around here. Wednesday, the buyers came in and pushed it to close up. Thursday, the sellers came in and did that. And yesterday was a draw. Opened here, went as high as here, and closed around the middle. So this MSTR is slightly different from the other two in the sense that the buyers keep showing up. You have green bars, you have red bars. There is a gap around here, 865. Of all the three positions, I think this is the one I'm most optimistic about, if you like, because it moves a lot. It can move over $100 a day, and I'm keeping an eye on filling this gap. Once that 865 gets filled and it closes around there or above it, I'll be looking to adjust the position to take some pressure off the move to the downside. So that's what I'm keeping an eye on this one. So that's the end of my positions. Now let me talk about I talked about offsetting my position to balance it off. So in my portfolio tab, in Tasty, if you go to this wheel, you can add another column called, I think it's called net delta net. This one here, delta net. This is my delta net column. Now deltas are additive, so you can add all the deltas together. So I've got a positive delta in GNOG 391. I've got a small positive delta in MSTR, and like I said, it moves a lot, so the delta on this one is quite small. The delta in XL is 377.91, all positive. That gives me a positive delta of 773 positive deltas. Now if I want to offset that delta, I'd want to use something that is strongly correlated to my positions. All these three positions are, so GNOG is a gambling stock, but it trades as technology. This is technology, and this is green energy, which is also technology. So I think they're more correlated to NASDAQ. So I would look at something like the triple Qs, the QQQ. So I'll look at something like the triple Qs, which is the NASDAQ 100 ETF, or I could look at something like the spiders, the S&P 500, or I could look at the VIX itself, and use one of these three to offset the deltas in my position. But let me go with the QQQ. So this is a QQQ. I have got 773 positive deltas to offset. And And ideally what I want to do is I want to buy options that are deep in the money and options that have close to zero extrinsic value. So options that have only intrinsic value, or about over 95% intrinsic value, and they act like a stock. So the closer to a delta of 1 or delta of 100 an option is, the more like a stock it behaves. So if an option has a delta of 1 or delta of 100, then it will move 1 for 1 with a stock. It has a 1-to-1 correlation with the underlier. To give you an example, QQQ is trading at, or it closed at 314. If I was to buy a 200 call on QQQ, the 200 call would be about $114 in the money. That would have mostly intrinsic value. It would have no time value at all. So if QQQ was to go up by 10, my deep in the money option would go up by 10. So that's why I would like to use an in the money option to offset the deltas. Another reason I want to use in the money options to offset the delta is because I don't want to lose too much theta decay. So when I sell spreads, theta decay works in my favor. Theta decay is my friend because I want the theta to erode the premium I collected. When I buy an option, which is what I'm looking to do to offset my negative deltas, theta decay is my enemy. So I don't want theta to decay the premium I paid to get it to buy an option. That's another reason why I'm looking to go deep in the money, because when you go in the money, the time value or the extrinsic value is 0 or negligible. So there's not much to decay. All you have is real value, intrinsic value. So using the QQQ, I'll be looking to, if I go to the trade tab, and say I look at the March options, given that I've got a March position, I can, let me do this. So these are my deltas once again, 391 for GNOG, 5.54 for MSTR, and for XL it is 377. So my position deltas are 391, 5, and 377. That gives me total delta of 773. My positions are 8 contracts each, so 773 divided by 8 gives me a delta of 96, positive 96 per contract, and that is what I'm looking to offset, 96. So if I come to the QQQ option chain, go to March, negative deltas here, you can see negative deltas. If I go down to the 96 delta, so this is 96 delta, it's a 346 put. QQQ is currently, or QQQ close at 314, so this is clearly deep in the money. This is where was it, 96, yep, the 346 is deep in the money and has little to no time value in it. It's mainly made up of intrinsic value, real value. So if I were to buy this 96, I need to 1 for the time being, you can see that the delta here is coming in at 995.62, which is close enough to 96. I'm not going to get a perfect solution. So I need to cover 773, and if I divide that 773 by the 95.62, I'll get about 8 contracts. So if I bump this up here to 8, I get a negative delta of 764. Now my positive delta is 773, so it's thereabouts. I'm not going to get a perfect hedge, but this is close enough. So that would offset my deltas, which means kind of neutralizing whatever happens in my positions. It's not a perfect hedge. For example, QQQ could be stuck halfway through and this position could lose money, and that other one, my other positions, could make money, but one doesn't make enough to offset the loss on this one. But this is how I would offset my deltas. But look at the cost of this hedge. The cost of offsetting my delta is $25,600. That is quite a number for offsetting my deltas. And if I choose not to go with this 96 delta and maybe I want to go further out of the money and do a spread, I could use the... So this is just buying the 96 delta straight away. That is quite expensive. If I wanted to, say, move closer, look at this, 322, still in the money, because 314, 322, if I sell the 322, no, what am I saying? If I buy the 322, and say I want to spread it out, and then I sell the 317, that would give me a delta of about 9.54. 9.54, and I need to offset 773 deltas. I think I would need to sell about, let me work it out. I would need to sell about 81 contracts to offset my $773. So if I increase this to 81 contracts, I get 772, which is much closer, but this is still 19,000, and the brokerage cost on this is going to be high because I'm doing 81 contracts as opposed to doing 8 of the other one. And the offsetting the delta using either the SPY or the VIX work out around the same ballpark. The cost of offsetting for me is way too much. And I am not looking to offset my positive deltas. I just wanted to show or illustrate if, for example, in addition to my options portfolio, I also had stocks which I wanted to hedge collectively, then I might be looking to offset the positive delta in my option spread book. But given the amount of the outlay to offset it, I think it defeats the purpose of offsetting it. There are 21 days until the March contract expires. A lot can happen in a day. A lot more can happen in a week, as we saw last week. And we have 3 weeks, so an awful lot can happen. So I'm not going to offset my deltas. I'm going to be on the lookout for when the individual positions can be adjusted. And as soon as I see an opportunity to adjust any one of them, I'll send out an alert. And that brings me nicely to the end of my journal for this week. Key takeaway, don't be too disheartened about the negative P&Ls in the positions. We still have 3 weeks to go, anything can happen. And I shall speak to you next week. Look out for alerts if the market bounces up and MSTI in particular fills a gap to 865. I might be looking to adjust that position. I think that might be one of the first ones I'll adjust. So have a fantastic weekend, and I'll speak to you next week. Goodbye.